Hi everyone, my name is Dennis Murphy, owner of Independence Business Consulting at IBC. We do all kinds of different loans, whether it be SBA, conventional lines of credit, you name it, we do it. But today we want to talk about asset-based lending. So to do that, we brought in an expert, John Klehm from Spectrum Commercial. He's going to talk a little bit about what he does. We're going to have a little bit of a Q&A. And hopefully by the time we're done, there's a full understanding from anybody watching this video on asset-based lending. So John, you want to introduce yourself?
Thanks, Dennis. Yeah, pleasure to be here. We've known each other over the years, and you've been great to work with on other deals, and look forward to chatting a little bit about asset-based finance.
Fantastic. So let's kind of jump into it. Asset-based lending. It's funny, even in the commercial world, you say asset-based lending, and different lenders will have different definitions of asset-based lending. So let's clear that up and give a definition of asset-based lending.
For sure. So asset-based lending broadly is where a commercial lender makes a credit decision based mostly on the, or not maybe mostly, but more on the assets, less on the business income. Like a traditional bank is really interested in balance sheet strength and consistency of earnings, whereas an asset-based lender, balance sheet is somewhat, maybe makes a little bit of importance, and cash flow makes some importance, but really the nature of the collateral is what's of primary importance. And there are different asset-based lenders that specialize in different types of collateral. Spectrum, as we are, lend on really 4 types of commercial collateral: accounts receivable, inventory, equipment, and real estate. But as you point out, there's different flavors of ABL. And there are ABLs that lend strictly on accounts receivable. There's ABLs that lend strictly on real estate. There's ABLs that lend just only on equipment. There's ABLs that lend only on inventory. And so you do have specialists out there, but we're a generalist and we lend on all 4 of those asset classes.
So when you talk about that, so there's a lot of asset-based lenders out there. It's receivables. We're going to do receivable lending. We're going to do the lockbox. All of those hot button terms, where you guys do bring in some other collateral. Can you talk about that? So let's talk about how it works. So if there's somebody sitting there right now, they're a manufacturing company, let's say, and they just Googled asset-based lending, and they maybe they have a big job coming in, or they've got a receivable and they need to gain some capital off that. But maybe it doesn't quite cover what they need, so they want to bring in some real estate. Can you kind of talk about how Spectrum Commercial would weight that and put emphasis on that, and then how the process works?
For sure. So most companies have more than just accounts receivable. And so there are just accounts receivable lenders out there, and that's what they do. And maybe that's the best fit for like a service company, maybe without really a lot of assets.
Right.
But for many manufacturing companies like we have here in the Midwest, or Michigan in particular, a lot of manufacturing companies that have receivables, inventory, we've got some sort of manufacturing equipment, and they've got real estate, or they might have real estate if they're owner occupied. And certainly we want to provide them borrowing capacity on all those assets. And so you might have a situation where they've got a working capital crunch, maybe because sales are growing rapidly and they're outgrowing their bank credit facility, or maybe they've had some losses and so they're working capital constrained that way. We want to be able to tap into those assets, whether it's equipment and real estate too, to give them the working capital that they need in order to get through, whether it's a growth period or whether it's maybe a period of time when they're losing money until they can turn the business around and be profitable again. But in terms of, to answer your question about process from there, so the different asset classes, really the differences, one of the differences is that each of those asset classes requires a different level of due diligence. So with the receivables, your only due diligence item is a field audit. You want to audit the books and records, make sure the receivables are real.
Right, make sure they're actually there.
Right. Inventory, you're going to do an audit to make sure the inventory is there and that it's turning and it's relatively good inventory. Equipment, you'll require an equipment appraisal. So because we're lending into riskier situations from a cash flow perspective, we want to make sure that the equipment is worth more than what our loan is gonna be worth with some margin, and so we're gonna wanna get an equipment appraisal.
Let me interrupt you there real quick. So when we talk about equipment appraisal, so I just went out and bought this CNC machine and I paid $300,000 for it. So you're going to give me X% of $300,000. It was the perception.
For
And
sure.
I think the reality is, no, we're going to do liquidation value, whatever it might be. Can you speak to that?
For sure. So, yes and no. If the equipment is really brand new, if they literally...
And that was an extreme example.
For sure, but
yeah.
it does happen. And if it's brand new, we'll lend on cost.
Okay.
And so we would lend, say, 80% of cost or
Okay.
75% of cost if they've recently purchased equipment. But if it's...
What is recent?
Good question. That's...
Within 6
yeah,
months,
I would
within 2
say,
months?
yeah, less than 6 months.
Okay.
If it's less than 6 months old, we would likely give them sort of credit for whatever it is that they paid for it.
Okay.
But yeah, older than that means it's been in place for a while, it's been used, and
Yep.
we're gonna wanna get an appraisal that's gonna tell us, okay, if the company was unsuccessful and we got that equipment back, here's what the equipment would sell for within, say, a 90-day period of time. And that's really the sort of the time frame that we're looking at for our sort of a liquidation period for that equipment assets.
Okay.
And then for real estate, similarly, again, we're gonna want some due diligence on the real estate to make sure the value is there, so we'll get an appraisal, but that's just a normal fair market value
Yep.
appraisal. And then we would wanna make sure, do the environmental due diligence, just like a bank, to make
Yep.
sure there wasn't any sort of environmental contamination. But, that's really it. And, we'll lend 50, maybe 60% against the real estate. We'll lend 75 to 90% of the auction value of equipment.
Okay.
Typically 85-50 receivables inventory, depending upon what those are. And there's some, that's going to vary a little bit based on situation. Sometimes you might have a company with very good inventory, maybe like finished goods, or they're an importer distributor.
Right.
And so you might lend more than 50% against that because, if you had to sell it, you could find a wholesale distributor. And so that's the underwriting, and that's the thought process that goes into it.
Okay, so we kind of talked about the front end of the process and what the appraisals are going to look like and how we're going to value and loan to value on the assets. Let's talk a little bit about, okay, I'm ready to move forward with you. You do all those third-party reports. They come back in. Take it from there. From then all the way to disbursement, and then what it looks like from a monthly monitoring standpoint, renewal, all of that.
Sure. Great. So, right. So with Spectrum and with most ABLs in the industry, the originator, the salesperson, myself, offers a proposal, and there's different degrees of due diligence that goes into that proposal. Spectrum is one that asks a lot of questions, which makes us super reliable to close exactly as proposed. But if we make an offer to our prospective borrower in that proposal, if that proposal is accepted, then we move forward. The borrower would give us a small amount of money to cover costs for an appraisal or a pre-funding field audit. And then once those items are completed, that takes about 3 weeks to a month to get, depending. A real estate appraisal is about 3 weeks. An M&E appraisal is about 3 weeks. And then we move to documentation. So one of the benefits of Spectrum, not every ABL works this way, but Spectrum actually front loads our credit process at the proposal letter stage, which makes us super reliable to close exactly as proposed. Other ABLs, which are fine people too, but after they collect the appraisals, then they do their credit
Right.
approval document.
Right.
And so, which tends to introduce a small element of risk in terms of do they actually deliver on that financing or not. But anyway, so you get through the due diligence, and then you move to documentation. So I would say, depending upon circumstances, I would say for just a straight receivables loan, under a month from the initial conversation to closing and funding.
Okay.
With a loan that has M&E and real estate associated with it, assuming the real estate due diligence can get done inside of a month, it's about a 6 week process to go from initial meeting to closing and funding and funding on the loan.
Okay. It's still pretty quick in
Yeah.
relation to traditional funding.
And our longest lead time item there is really the third party due diligence,
Right.
and sometimes we can get them to move a little bit quicker. Based on our relationship with some of the third parties, people, sometimes we can, if the timing is super important,
Right.
we can kind of
Bump them along a little bit.
jump the line a little bit.
Yep. And so often clients will ask me in any form of lending, how quick is the process going to be?
Yeah.
And my response is, that's not necessarily about me, that's about you. And
For sure.
How do your financials look? Well, I haven't filed tax returns in 2 years. Okay, well, that's going to be a problem. Get to your accountant, get those cleaned up. How organized are you? Because I can't start and you can't start that process until we have all the documentation. So I just wanted to piggyback on what you're saying. It's great to say we could do it that quickly, but the starting pistol doesn't start until we have all the documentation.
For sure, and my credit people will remind me
Yeah.
when I ask them about how quickly can we get some closing funded, it's does the borrower have complete information, and can they provide us everything that we need at the jump?
And I just
so
think
that we
that,
can move quickly.
yeah, and I think that's something, again, if somebody's looking at this video and, hey, I need this as quickly as possible, get with your accountant, get with your bookkeeper,
Sure.
get with your CFO, your controller, whoever it might be. Make sure you have your ducks in a row, because we're going to look for 3 years tax returns, personal financial statement, year-to-date income statement and balance sheet. Make sure everything is reconciled and up to date so that baton can be passed and we can run with it.
Exactly.
Right?
Yeah.
Sounds like we said, that's a little quicker than traditional funding.
Yeah.
Can you kind of juxtapose asset-based lending against conventional financing?
Sure. So again, a conventional loan or a bank loan, the credit consideration is going to be weighed heavily on the sort of strength of the balance sheet and the consistency of earnings on the income statement.
Okay.
And so with an ABL, those things are much less important, and it's really about the quality of the collateral. Another feature, and sort of maybe going along with that, asset-based credit facilities typically involve very few covenants or zero covenants. And so Spectrum...
Elaborate on what a covenant is.
So, for sure. So, a commercial loan with a bank is going to have requirements that you maintain a certain level of income, or is going to require that you maintain a certain balance sheet strength, or debt to equity ratio, or a debt service coverage ratio. So those are common financial performance covenants that a bank would have, that an asset-based loan, Spectrum would not have. Some asset-based lenders still want to have a covenant or two. Spectrum is one that doesn't require any financial performance covenants whatsoever. It's simply a matter of, is there enough collateral there for us to make the loan? And do we have confidence in management and their strategy to turn the business around? And if the answers to those two questions are yes, it's pretty likely something that we can do.
All right, I want to pick up on something you just said. You talked about confidence in turning the business around.
Yeah.
Asset-based lending, though, in my experience, and as we've done it over the years, isn't just about, I think there's a little bit of a stigma attached to asset-based lending at times. You couldn't get other financing, so you did that. No, that's not the case. Your company can be healthy, but maybe you got a big job in, maybe you want to add another shift because you can't keep up with production, and you're just throwing capital at this, and you reach a point where I can make exponentially more money, but I don't have that liquidity right now.
For sure.
So I'm going to convert some of my receivables, and some of the a CNC machine sitting on the floor doesn't give me any more cash in the bank. However, if I collateralize that and you lend against it, it does. I want to make sure that, again, anybody watching this understands that this is a great tool to get to kind of squeeze money out of the things around you that a traditional banker might say, well, what am I going to do? I don't want to take that and liquidate it. Well, that's kind of where you guys come in.
Right, exactly. So, a great example. So actually, just this week, I was talking to a company that has a very good bank relationship with one of the bigger sort of blue chip banks. I'll just put it that way. So, very good company with a very strong bank and prestigious bank. And companies in the consumer product space, and they are growing very, very rapidly. and there's no blemishes at all associated with this company whatsoever. Just they need more capital to grow.
Right.
It's just that simple. And the bank, they want to lend really just within certain parameters. The company's credit needs in order to facilitate that growth puts them, at a balance sheet leverage that this blue chip bank is uncomfortable with.
Right.
And so that's a great opportunity for us to be a growth partner for a terrific company, a couple that has a great story and a great product, and it's just taken off like wildfire.
Well, that goes back to something that was discussed in my office earlier today. Clients will often say, well, nobody's going to lend me money. I went to, this national bank and this national bank and this national bank, and they all said no. And it's like, okay, they were never going to do that loan.
Right.
They're very conservative. It's just not going to happen. But it doesn't mean you're not lendable. It doesn't mean you're not lendable even for conventional lending somewhere else. But certainly doesn't mean that SBA is not an option, asset-based lending is not an option. So my point to that is don't get discouraged if you get a no from a bank. Obviously IBC, Spectrum, we deal in that type of thing. We can do, IBC, we can do a paper, but we can do alternative lending. And that's why we deal with people, whether it's private money lending, SBA lending, asset-based lending, there's almost always a solution
For sure.
out there.
Yeah, and just to elaborate on that, it's not uncommon for us to talk to a company that's talked to many banks. And what I would say is the credit appetites among the different banks does vary.
Yep.
But it doesn't vary that much.
Yep.
And so the credit appetite from the bluest of the blue chip banks to the most flexible and understanding community bank does vary, but it doesn't vary that
Still
much.
a box that they're in.
And
Yep.
so just because a company got a no from a community bank and the blue chip bank doesn't mean there isn't a credit facility out there for them to get at a reasonable cost. And so that's what we're really all about, is providing a reasonable cost of capital and access to capital that might otherwise not be available to them.
Okay. So, all right. So I think we've kind of get a feel for what asset-based lending is. We know it's fairly quick. We know just because a bank, the guy in the gray pinstripe suit says no, doesn't mean that there isn't still an alternative out there.
Sure.
And again, there doesn't have to be a stigma. Let's talk about something that's come up in the past when I've had clients do asset-based lending. Talk about the lockbox and again, a little bit of, well, I don't want suppliers necessarily to or my customers to see that I'm in an asset-based lending lockbox type thing.
Okay. So that is something that we talk about with our clients, and so you're right. So Dennis, for an asset-based loan, and not to get into the weeds too much, a lockbox is important, and I can sort of share details at different times sort of why that's important. But for an asset-based loan to really function, there has to be a lockbox of some sort, and that means customer payments are directed to a PO box or a bank account that the asset-based lender can sweep daily to pay down the credit facility. And the short answer is we lend on the receivables. Once those receivables become cash, you have to really collect the cash, pay down the credit facility, but the company has issued more receivables, and so then they just borrow that money back. So it has a mechanical up and down. But in terms of, to address the question about, oh, my customers are going to find out, or my customers are going to be concerned about me going to a new bank or an asset-based lender, here's what I would say, and this is what we see with our clients, and it isn't really a problem. Most customers have purchasing departments.
Right.
So our clients have relationships with customers and provide products, and they're dealing with the salespeople maybe, or the engineering people at those companies. But the purchasing people are the ones that pay the bills. And so it's really a matter of just changing, submitting a form to the company that changes the direction of the payments. And it's two separate departments really within most corporate customers of our customers that, so the two never really talk, and it really, in our experience, it doesn't come up as a negative for our clients. One thing that's important to note is the lockbox actually is a deposit account that's still in the name of our client. So Spectrum's name doesn't come up anywhere.
So the client doesn't see that at all.
The
They
client
still
never
think
sees
it's coming from ABC Manufacturing.
It still goes, so payment
Okay.
is still going to ABC Manufacturing at this PO box, or ABC Manufacturing at this bank account and this deposit account. And so Spectrum doesn't show up anywhere.
Because I think there has been in the past, I don't think I know,
Yeah.
clients have said, because there've been different situations where it is collected and there's a letter that goes out and you know, probably a factoring situation. I want, again, anybody who's contemplating asset-based lending, nothing changes in the forward-facing portion of that. So there's no stigma attached to it in any way.
That's
so
an
I think that's
important
important
distinction,
to,
Dennis. Yeah, so with traditional factoring, oftentimes the finance company factoring receivables the payment goes directly to them. And so the end customer then knows that there's a factoring company involved, and that can carry a stigma. But yeah, no, we're completely behind the scenes and the client's never gonna know.
Okay, so I think that dispels a myth, so that's good. So let's talk a little bit. Give me a couple of stories, couple of,
Yeah.
you know, we can change the
Sure.
names to protect the innocent,
For sure.
but tell me some real life stories.
Sure. I mean, that's part of what I enjoy about my job is actually helping companies through transition, a difficult time or a growth period, or maybe a difficult time. And yeah, one of my favorite stories actually was with a local company here in Metro Detroit that was with a bank actually that got into some trouble. The company itself, our client, had a couple of hiccups on their income statement, but I would say their bank overreacted, and so asked them to leave. And so this is a great client for us, and they were a client with us for maybe a year, maybe less, and they were really ready. They had kind of a bump in the road and a hiccup, and they were off on their merry way and back at a new bank, not going back to the old bank,
Right,
but
sure.
at a new bank. And they're very happy. I run into this company from time to time, and they're very happy with their new bank. Maybe another situation was with a long-time tooling company that had really tremendous equity in their assets, and they really didn't have any bank debt at all, and they were really facing really severe financial issues and really needed access to capital in order to help them transition from the way the tooling industry used to work to the way it works today. And so that's been a great story to see this 50-year tooling company transition and survive and start to grow again. And they're currently a client, but I think that they'll be moving out here in the not too distant future.
So would you say then that, are you a stopgap? Are you a temporary solution or a long-term solution?
Most of the time, we're a relatively short-term solution. I would say most of our relationships are 2 or 3 years or less. Sometimes as short as a year, sometimes as long as 3 or 4 years. Sometimes our clients choose to stay, and they've maybe gone through bank relationships in the past, and every 3 or 4 or 5 years they have a couple of losses, and they don't want to go through that drama again, and they like the no covenants, and they're willing to pay, you know, a couple hundred basis points more than what they would pay at a bank to stay with Spectrum, and the level of service that they get and the flexibility that they get is worth it to them. And so I would say once in a while that happens, but certainly most of our clients, we're here to help them get from point A to point B, and that's the role that we play, and that's okay.
And that makes sense, and I think any business, any small business hits a growth spurt.
Yeah.
And to fund that growth, you know, if you're not growing, you're dying.
Yeah.
So you have to get the capital for that growth. It's funny, I had a client, a trucking company one time, and we refinanced them and gave them a line of credit and got them out of asset-based lending. And he called me back up a month or two later, and he said, is it okay if I go back and get some asset-based lending? I'm like, we set you up. We saved you a ton of money every month. You've got this line of credit. He said, I know, but the asset-based lender, everything was so easy. And they essentially collected everything for me, and I didn't have to worry about that.
For sure.
It is so worth paying a little bit more.
Yeah.
They're my receivables department, my collection department, and it was like, sure.
Yeah.
And it made total sense.
For sure.
And it kind of changed my thinking on
Yes.
how asset-based lending is utilized,
Right.
and how there's just a lot of benefit that you're just not going to get with the, you know,
sure.
the guy down at the bank. And, you know, I love bankers, and most of
Yeah.
my clients are bankers, but he's not going to go help collect on receivables. But an asset-based lender,
For sure.
they're right there doing that with you.
Right, there are certain companies and certain industries in particular that just lend themselves well to the asset-based lending industry, and trucking is one of them.
Yep.
Where it lends itself to the EBL industry, and I think, yeah, the asset-based lending industry broadly has kind of taken over the trucking industry.
Yes.
You know,
Yes.
you don't really see very many trucking companies now at commercial banks. The ABLs have kind of taken that space over.
Yep, and rightfully so. It works best for everybody. So that's a lot of information, a lot of good information. But I know, you know, because I get the question in every aspect of commercial lending. But I always explain that there's two portions of commercial lending.
Mm-hmm.
There's the asset,
Yeah.
whether it's asset-based lending or traditional lending. There's a building, there's a business, there's equipment, whatever it is. But that asset doesn't pay the bills.
Yeah.
The human being pays the bills.
Sure.
So we needed to do the 5 C's of credit, all of
Yeah.
that, do the personal financial statement, credit report. So I know that's a question that's going to sit in the back of the mind of a potential borrower. So can you talk about personal credit and how that affects your process?
Great. Yeah. Actually, it doesn't
Okay.
our process all that much.
Because you have the asset, right?
We have
And
the
that's
asset,
all
so really, it's not uncommon. I mean, I shouldn't say. Personal credit score makes almost zero impact on our credit evaluation, credit decision. We're looking for good people that are trying to help the company be successful. Their own payment performance on their own bills, or sort of whatever maybe that's impacted the credit score, makes almost no impact on us. And we finance companies. I've got borrowers and the principals that have great credit scores, and some of them would have some pretty low numbers, and it doesn't really make any difference.
Which that makes perfect sense. I mean, we've used the term asset-based lending, you know,
sure.
probably 20 times here today.
Yeah.
The asset, and if we had to liquidate and looking at the receivables, those are tangible things that you can collect on.
That gives us tremendous flexibility. So that gives us confidence to be a good partner, even in the face of a scary income statement, that maybe a company's losing money and maybe meaningful amounts of money. But being an asset-based lender, we know that we have tangible collateral that allows us to be a relaxed, good, supportive partner for our borrowers. And that's the approach that we take, whether it's a personal credit score or income or corporate income statement that isn't performing very well.
Okay, all right. So that's a lot, and we appreciate it. And there is kind of a little bit of a cloud of mystery at times around asset-based lending. So thank you for lifting that today. Thank you for being here. Thank you for spending the time.
My pleasure.
Again, this is the latest in our series of just trying to explain different types of lending and letting our small business clients know that they're not alone. There's a ton of options out there. They can obviously come to IBC and we can help them through that process. But if somebody wanted to get a hold of you, well, I guess first of all, is there anything else that you would like to touch on that you feel maybe we haven't touched on?
You know, Dennis, you've done a great job of asking questions. So
Thank you.
So thank you. No, it's been my pleasure. Again, certainly have a tremendous amount of respect for you and what you've built here at IBC, and I know that you have a number of different channels, lending solutions that prospective borrowers that might not fit into a traditional commercial lending box might benefit from, and I completely support that, and we're here to be a resource for you and for your clients. To the extent that somebody might have a question for me about specifically about asset-based finance, you can reach me at john.klehm, K-L-E-H-M, at spectrumcommercial.com. But I'd encourage them to reach out to you, and you're gonna be able to answer their questions maybe as well, and maybe you'll have some alternatives for them to look at. But we certainly are eager to be a financing solution for any of your clients or any of the folks that might see this video. So thank you very much.
Thank you. I appreciate your time. We'll talk to you soon.
Sounds good.